In this video, similar to a couple of other YouTubers I've been watching recently, I'm going to give you my pick for if I could only own 3 stocks in the whole world, what would they be? Yeah, in this video I'm going to copy a couple of other YouTubers, JJ Buckner and my financial friend Sam from My Financial Friend I've been watching recently, and they've done a pick of if they could only own 3 stocks in the whole world and the whole of the stock market, what would they be? So I'm going to do a similar one to that. There may be some overlaps maybe of similar stocks, but going to do a similar video and sort of explain to you kind of why I'm picking these stocks. And if you watch my channel you can probably guess maybe a couple of them already. But before we go any further, I need to give another shout out actually. Anthony Cotter, another YouTuber, I'll tag all his details up in the corner there. I've been watching his channel recently. Really great content, really quite amusing as well. I particularly like the Christmas themed ones recently, and the one where he compares all Christmas foods and he taste tests lots of Christmas food from different stores, Aldi, Sainsbury's, M&S, Thornton Mason, things like that, and then reviews them and tells you whether you should be buying all the expensive Christmas food. So I particularly enjoyed that. Head to his channel, I'll tag his card up there, and he does lots of very interesting videos on there. So give him a little follow, a little subscribe, and check out his content because it's really good. And as always, if you haven't already subscribed to my channel, do so below. Just hit that little subscribe button, it'll be much appreciated, and you won't miss out on any future content. And while you're down there, give it a little like as well. Yeah, so we're going to go through the top 3 picks if you could only pick 3. Now, I'll explain why I'm picking these stocks sort of as I go along, but the premise of it is, please bear in mind throughout the video, 2021 is still going to be a very uncertain year. We don't know what it's going to bring. We don't know if there's going to be any more lockdowns, any more furlough, any more anything. There's just so much uncertainty. So these picks for me are not going to be top picks for 2020 for growth or 10x your money or anything like that. There's plenty of YouTubers out there doing 10x your money, and they're putting wild, uneducated predictions on where they think the price is going to go to. Go and follow them and go and watch those videos if you want. This is going to be, in my opinion, a no nonsense right. For me, these are the safest places to put my money because this is where I do genuinely put my money. This isn't just me making it up as I go along. I'm invested in all of these. I'm quite heavily invested in all of these. In terms of monetary value that I have in my portfolio, 2 of them are in my top 5, and out of the top 6 holdings in my whole portfolio, all 3 of these stocks feature. So this isn't a grab your attention, get the views, I'm going to 10x your money with BNGO stock, which I bought recently actually. But this is genuine solid picks of where I think it would be absolutely pretty safe. Small disclaimer, there's no certainly certainty of anything. You could lose all your money, but the safest way, in my opinion, that you can put your money into the stock market, put it to work as well, because all 3 of them pay a dividend, which is good. More clues. But the safest place is to put your money in 2021, where we're going to have a bit of uncertainty. And yes, you could put your money into a penny stock that will 10x. That's always possible. You could also put your money into a penny stock and you could lose it all. So let's go for well-established companies and stocks that are going to be a much safer bet. So I'll get into it straight away. Not straight away because I've rambled on, but I'm going to get into it now. So the first company is going to be Apple. This may not surprise some of you. Apple is already in my portfolio. It's in the number 5 spot in terms of its holdings. I own a fair amount of Apple and I'm still very bullish on Apple. To me, Apple is going to be a couple of plays. It does pay a very small dividend. I'll show you in a second. So you do get back from Apple. I got paid, last Apple payment was £3.28 or something. I don't know, I think it was. So very small dividend going forward. Apple's going to be my growth play. To me, it's not a penny stock growth play where it's going to 10x or you could lose your money. It's a well-established company, obviously. It's got brand loyalty. I use Apple. I love Apple products, and it'll always be my go-to. It's got brand loyalty. It's a very popular brand. It's innovative. They're forward-thinking. They're always coming up with new ideas, and they're bringing out. We believe they're bringing out a car in 2024 or around then, between 3 and 4 years' time. So they're branching out into different areas as well. They're going to be like the new Amazon, where if you want something, you want to buy something, first stop, you go to Amazon because they've got everything. They sell everything and they do everything, and they're very diverse in what they do. They're going into the media space and streaming and things like that. Apple has got all of that, but they're now also branching into the automotive and autonomous vehicle space, which is just massive. So they're becoming the Amazon. If you want something, well, Apple will do it. You know, we'll get an Apple this or an Apple that, and it won't be long before you can get an Apple toaster. I don't know, they may already do one, who knows. So they're just becoming far more diverse, and they're still very much a growth stock for me. Right, starting in the portfolio as always. So I put this down in a monetary value. So we've got Apple here, 3,313 is the value there of it. So that's transparency. It is 1, 2, 3, 4. It's fifth in terms of monetary value in my portfolio. Just for complete transparency, say, look, you know, I'm not just preaching these companies and don't invest in them myself. I absolutely do. We're in Seeking Alpha here, so a couple of notable things. We don't need to go through loads of Apple. Everybody really knows Apple. The yield, we've got a just over 0.5% yield. It's been growing for 9 years, which is quite nice. It's grown an okay amount. Payout ratio, so there's room for growth in the yield. We've got a tiny payout ratio of 20%. You don't see that very often at all. They say 60% is the sweet spot, so 20% is absurd. That basically means, if you're not aware, of the profits made by Apple, only 20% of those profits are paid out to shareholders in the form of a dividend. 80% of the profits go straight back into the company to continue growth, development and innovation, and which is why it's a growth stock. Really certainly still in my eyes in the tech sector, and having a 20% payout ratio is amazing. Growing their dividend for 9 years is great as well, but a tiny yield. So it's not a big payer, as I said out there, £3.28 or something, whatever it was, the last dividend payment. Anyway, so this is a little bit about their car. So we've got another article from Seeking Alpha about Tesla versus Apple versus Tesla, just giving you an outline. So you can head to this article, it's free to read. Some of the ones on Seeking Alpha you need to be a member, but this one you don't. So you can read this article, it gives you an idea of what it's about and when it's coming. So 2024, they're looking to bring out the car if possible, just basically to compete with Tesla, really. And that just shows diversity in the company, and they're wanting to branch out into different sectors and things like that, which is I think it's good. Anyone will think it's good. So I want to show you what the car might look like as well. There's so much speculation on what the car could potentially look like, and there's just some absolutely ridiculous ones like that. And where is it? I mean, that's not a car. It looks like a futuristic gaming mouse. There's no certainty on what the car will look like yet or anything like that, and we haven't heard formally, I don't think, from Apple yet, but there's plenty of speculation. There's enough on here. I mean, that's an Audi steering wheel. There's enough speculation on the internet to know that it's probably coming. But yeah, so just wanted to go through kind of the overalls. The only other point sort of worth mentioning is its PE ratio, price to earnings. It's 33. You know, again, people say the sweet spot is anything below 20 to 25 would be great and undervalued. I think any company over that needs to really have a bright future, because investors are getting into the company knowing that they can justify the larger PE ratio. 33 is not, I don't think it's terrible, to be honest, for a company like this, and for what's coming in the future. I think that will more than cover itself, and I think that it's still worth getting into at that sort of level. If I quickly compare the PE ratio of Apple to Tesla, Tesla has a PE ratio of 292. So that's the bullishness of Tesla. That's what people truly believe in the company. They're willing to invest into it, even with a PE ratio as high as that. And that shows the sentiment in investors getting into the company. So Apple's still looking, compared to someone like Tesla, is looking like a good play. And if we just compare it to a competitor, Microsoft, 33 as a PE ratio for Microsoft as well. And I think, in my opinion, Tesla's got a lot more coming and a lot more hype and a lot more excitement over it than the likes of Microsoft. Tell me if I'm wrong, but that's just the way I see it. So they're my thoughts on Apple, and that's why Apple is my first pick. On to number 2. The second stock on the list for me is AT&T. You may have known this was coming because I am a big fan of AT&T. I'm still very bullish on AT&T. They've grown their dividend for 36 odd years. They've got a huge yield, which may or may not increase now because they've got large amounts of debt that they are paying down. It's being managed. One of their worst investments recently was DirecTV. They've pretty sure they've secured a buy now for DirecTV, which is great news. And their new streaming service with HBO Max has had a very positive response. So again, they're not just phone carriers, providers and service providers for phone network. They're branching out into the media space and the streaming space as well. They've got a huge yield of over 7%, 7.23, I think last time I looked. We'll look in the computer in a second. So massive yield. So this is my income, my yield dividend stock play. I still think you should be bullish on them for the long term. They're still not back up to the highs they were in pre-March dip at all, 28 something, you know. So I still think they're a value play as well. I think they're a value play. I think they're a solid long-term hold. They're a blue chip that are going to continue to do well in the future. And I think even if they don't increase their dividend for a number of years because they want to concentrate more on paying down debt, 7.23% or whatever it might be is still just massive. They don't need to grow that for the foreseeable future, but they're the type of company that will want to pay back their shareholders and will want to increase their dividend. So they will do in the future once they've paid down a bit more debt maybe. They've got huge amounts of cash flow, which is how they've been able to pay their debt down. More recently, in the last few years, they paid tens of billions down of their $190 billion worth of debt they got up to as an absolute they peaked at $190 worth of debt, and they've paid tens of billions down more recently. So it is being managed pretty well. They've got huge amounts of cash flow. They're a great company. They're so well known. They've been growing in the dividend for 36 years, and it's got over a 7% yield. So that's my next pick. We'll get into Seeking Alpha and we'll look at the yield and an article actually on their streaming service quickly. Okay, so AT&T, and again I'll start in the portfolio. So it's number 6 in my portfolio. 1, 2, 3, 4, 5, 6, with $3,134 worth in there. So again, complete transparency, I am in it. I bought a lot of my AT&T shares at, in fact let's open it up, I'll show you. So I bought a lot of my AT&T shares back here and we rose up and it was fantastic. And I had a great end to 2019. Look at this, lovely. It was up here and it was doing well. Come on. Anyway, so still at lows from where it has been. You know, it certainly towards the end of the 2019, it was a $35+ share, and it's trading at the moment at 28. So I still think it's a good value play for the long term, for the future. We've got an article in here about AT&T's streaming service, and just saying that the model that they brought out, it's interesting because of cinemas and theatres, really majority of them being closed, or depending on what state you're in the US, them being closed. They introduced a streaming service that basically aired a brand new, well, it was Wonder Woman, you can see here, 1984, brand new film on HBO Max, and you had to subscribe to it for a brand new film coming out in cinemas. This is AT&T's way of capturing that cinema market, I guess, if you like, and creating its own cinema, its own theatre. And that had very positive reviews. By all accounts, the film itself didn't have very positive reviews, but the streaming service and the whole concept of it and the idea had very positive response. So again, another article on Seeking Alpha. Get yourself onto there and have a little read up of all these. Well, this one's completely free as well, so it's just interesting to see that. Now, if we go into AT&T in here, we've got a PE ratio of 9. So again, it's considered pretty undervalued at the moment, and I certainly would consider it from what it's been at and what it's got coming in the future. It's undervalued. A lot of people are a bit scared of the levels of debt, and it just spooks them. They're like, nah, not getting into it. But they've got that, as far as I can see it, pretty much under control. The main thing, amazing. The main reason you're going to be getting into AT&T is that big 7.23% yield. It's got a 65% payout ratio, which is still absolutely fine. It hasn't grown it a great deal in the last 5 years, but do you need to at 7%? Probably not. You're just being greedy now, and it's grown it for 36 years. So that's my dividend play. That's my income play. And that is stock number 2. On to number 3. Right, the third pick number 3 is a bit sneaky, I guess. It's not a company as such, although Vanguard is an investment company, I guess. It's an index fund, it's an ETF, and I'm going to go with my good old favourite, VOO. I'll put 2 in this. You've got an option, VOO or VTI. I'd be bullish on both. My portfolio, my top holding in terms of monetary value is VOO, the S&P 500 tracker, and my second biggest holding in my portfolio is actually the total stock market index, VTI. both Vanguard, both ETFs, and would both be absolutely fine in this situation. Reason for these: safest way of investing, probably safest play you can probably go with. They diversify their money for you. They track an index that's already exists in the form of Standard & Poor's, S&P 500. They're also a dividend payer, so they pay 1.5% just for the sake of owning them, which is still great. And because I've got quite large holdings in them, I get a reasonable amount. If you watch my last video, the last few dividend payments I got in December was all my Vanguard holdings, which was a lovely Christmas surprise. Not surprise, I knew it was coming. Lovely Christmas bonus, let's say. So they do pay a dividend. But I just feel like, again, harping back to what I was saying at the beginning of the video, if you're 2021 is, we're gonna have so much uncertainty still, I think. I really truly believe that. And so why not invest in something that's gonna be a much safer bet, diversify your money for you? And yes, you know, the S&P could suddenly go down by, could be one of those years it goes down by 10%. But look, these are long-term plays, these are long-term holds. I'm not saying you're gonna make loads of money just in 2021 with this. You invest in 2021 and it goes down 10%, it's fine, buy more. I did exactly that. So I started investing in these late 2019 heavily. You know, I had a good sum of money, $5,000 or so in each index fund, maybe 5 and 3.5 or something. And then obviously March came around and they went down by 20, 30%, whatever it might be. But that's fine, it didn't bother me. All I did was I bought more. So they're long-term plays. I think they're gonna be the safest place to put your money because these index funds diversify for you. S&P 500 is the top 500 companies in the US. Total stock market index has over 3,000 companies involved in it. So that's really diversified. So if a company isn't performing, or it doesn't hit the criteria needed to be in the S&P 500, it's bumped out of the S&P 500, it's relegated, so to speak. And companies that do qualify to be in the S&P 500, like Tesla was recently added into the S&P 500. What a great addition into the S&P 500. Tesla, the index fund, has suddenly gained a little bit of popularity because Tesla's got such hype behind it. They'll swap and change their companies within the S&P 500 depending on how well they're doing. So they'll only ever have the best companies and the top companies in the S&P 500, which makes it a relatively safe bet. And if you've got an investment firm like Vanguard, and there are other investment firms that will do this, iShares, Fidelity, and loads of others, they'll track the same index fund and they will just copy what the S&P 500 index fund is doing. So it's the safest way. So that's why it's on the list. That's why it's the largest holding in my portfolio. It's the safest way to invest your money, and I'm pretty sure the S&P 500 over the last, since inception, has returned between 7 and 9%, depending on what report you look at and depending on whether they include dividends compounded in that. Anyway, but you've had a pretty healthy return year on year with the S&P 500. Yeah, so on to number 3, so Vanguard. So you probably would have noticed already my top 2 holdings in my portfolio is the Vanguard S&P 500 ETF, which I have $6,530 worth in. The Vanguard Total Stock Market Index Fund, which I have 5,255% in, and we're up quite healthily on both of those because I ploughed a lot of money into it during the dip. Top 2 holdings are my top 2 stocks, I guess, picks: Vanguard, S&P 500 or Total Stock Market Index Fund. There's not a lot I need to really talk to you about. In this, we've got a 1.54% yield. There's very little more I need to talk to you about Vanguard Index Fund. So I just wanted to get onto Vanguard's website. There's loads of ETFs you can look at on here, whatever one picks your fancy. There's FTSE 100 ETFs if you want to stick to UK stocks. There's S&P 500 trackers. There's emerging markets. There's loads of every sector you want to get into. So we've got the S&P 500 one here. It gives you a breakdown of everything you'd want to know, the current NAV, the net asset value for the ETF, which is pretty much bang on. 343.93, 343.69, so nearest makes no difference. The performance is done over the last 1, 3, 5 or 10 or since inception, and it will give you a breakdown of its holdings. So 10 largest holdings: Apple, Microsoft, Amazon, Google, Facebook, Berkshire Hathaway, Johnson & Johnson, JP Morgan, Visa, Procter & Gamble. You couldn't get a better top 10, really. I don't know. Procter & Gamble, Johnson & Johnson, JP Morgan. Would you want anything else in there? No. It gives you a breakdown of the percentage of the sectors that they're invested in. So they're pretty well, relatively well diversified across the sectors. Maybe materials and REITs and utilities are a bit lower, but who really invests in utilities, materials sector anyway? We've got loads in tech, we've got loads in communication services and consumer discretionary, consumer staples, not as many actually, but gives you a breakdown of everything involved in the ETF and gives you some more information about it. So you get yourself onto the website, because I think you might find it quite interesting just to have a breakdown of the ETF and learn a bit more about the ETFs and what they cover. So that's stock pick number 3, largest holding in my portfolio. So why would I not peddle a stock, an ETF that I'm genuinely invested in and properly believe in? So that's pick number 3. So that's my final pick. We've got Apple, we've got AT&T, and we've got S&P 500 tracker in the form of Vanguard VOO. So we've got a growth stock, we've got a dividend play, income, let's say, and we've got an ETF. Every single one pays a dividend, which is lovely. So you're going to consistently get your payments in quarterly as well. But they're my top 3 picks for what's probably likely to be an uncertain year, or an uncertain 2 years, 3 years, we just don't know. So that's where I will be, and I am putting my money. You can go into these penny stocks if you so wish, but it would not be my advice. And in actual fact, it's not my advice to go into Apple, AT&T, or the Vanguard Index Fund. It's just what I'm doing, and that is what I would consider be sort of a safe-ish bet if you want a top 3 portfolio. That's it for today, guys. I hope you enjoyed that. I hope you gave you some sort of value and an insight and some ideas and some inspiration. Pop down in the comments what you're getting into or what your top 3 portfolio would be. In fact, do exactly that. What would be your top 3 picks if you had a 3-position portfolio? What would it be? I'd love to hear what you have to say. And subscribe to the channel and like the video if you haven't already. But you should have done that already. But if you haven't, get that done. And I'll catch you guys in the next video. See you later.